Very good afternoon, a very good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, a Chief Market Analyst. I do hope everybody is well and that you can see my screen and hear my voice okay. Don't forget, as we look at different instruments, different trading outcomes, the whole idea of this webinar is that you look over my shoulder, someone with a professional trading background, and you go to see how about I make trading decisions. It isn't a signal trading service as such at all, so please be aware of that. The key event that we're going to be looking at for this week is the core PCE print. Now, this is a really crucial print, the US core PCE, and as it is with all risk events, we need to look at what's expected, what will be the surprise, what's the big picture, and then what's the instrument to potentially trade it. And in this workshop, I'm going to be showing you what I'm looking for and what potential trades I'm wanting to look at as we look at the core PCE print on Friday. So very good morning if you're just signing on. Very good morning to you, Gavin. Good to see you here. Good morning, Maurice, Danny, Eamon, Gabriel, Mohammed. And as other folks are coming on, we're going to have a quick overview of where we are with markets. Now, before we look into the core PCE, I want us just to get up to speed with what the big picture is, because it's very important to understand the big picture right now, particularly with so much changes going on. So the first thing to be aware of is that the Federal Reserve interest rate pricing is now very different according to short-term interest rate markets versus what the Federal Reserve have already stated. Now, if I just have a look, see if I can find the latest dot plot. The latest dot plot is showing that the Federal Reserve is not expecting any interest rate cuts this year at all. If you go along to, this is the blog HYCM, and I provide the majority of the material for this blog. And in it, you can see, you know, the latest central bank reviews, which I do, and you can see the Federal Reserve. I covered that interest rate decision, and this is the dot plot that we had from the last Fed decision. And you see the Fed are projecting no interest rate cuts this year at all. Okay, but if you take a look at short-term interest rate markets, and you can see that the current interest rate is 4.875%, but short-term interest rate markets are projecting 2 rate cuts by the December of this year. So the first thing to be aware of is that there's a disagreement here between short-term interest rate markets and what the Federal Reserve has stated. Now, which one is correct? Okay, so if the Federal Reserve is correct, and we're going to see no rate cuts this year, that would pressure stocks. That would lift the dollar, and that would be a negative for precious metals. But if the short-term interest rate markets are right, if there's 2 rate cuts this year, then that would be supportive for stocks, weaken the dollar, and that would support precious metals higher. So at the moment, what the market's trying to work out, you know, which of these 2 narratives is right? Short-term interest rate markets representing the markets saying, no, the Fed's going to cut twice. So we've seen the dollar weaken, that's been lifting the majors. We've seen the major indices just tracking higher over the last few days. And the recent reason for falls in stock markets, particularly at the start of March, was the Silicon Valley Bank crisis that resulted in the first national signature bank crisis, which resulted in a flow over potentially to Credit Suisse, and the worries that that was going to have a contagion effect amongst European banks. Now, a lot of those banking fears have faded, but they haven't disappeared. So as long as those banking fears remain, then stock markets could sell off quite quickly. Why? Because stock markets fear a repeat of the 2008-2009 global financial crisis. And if you look at oil's reaction, you saw oil reacted so strongly to the global financial to the banking crisis, you see how heavily it sold into this key support area. Now, when it sold off so heavily, it was like it was a kind of reminiscence of the global financial crisis in 2007, 2008, where oil fell from $145 a barrel all the way down to like $35 a barrel. So that's why markets snap lower, but they have bounced very firmly from that 200, 100 exponential moving average, great support level that we pointed out on either this webinar or the Monday webinar or the Wednesday workshop, and saying that was a great place to look for medium-term longs. We're now at a key kind of decision point. We're retesting this bottom trend line from December 2022, February 2023, and we're retesting that level. But the reason we've seen stocks gain, commodities gain, is some of those banking fears have faded. And markets are hoping that the Fed is going to be cutting twice this year. Now, the reason the Fed is not expecting to cut interest rates, according to the Federal Reserve, is because inflation is very, very high. So if you just take a look at headline inflation over in the US, let's have a look. Headline inflation 6% year on year for February, and the core was 5.5% year on year. Now, the headline and the core are tracking lower. So you can see the core tracking lower, the headline tracking lower. Now, the only tool that a central bank really has to contain inflation, and most central banks want inflation to be around the 2% mark. The only tool they really have to contain that inflation is by hiking interest rates. Now, the way it works is when a central bank hikes interest rates, that reduces demand throughout the economy. Because a central bank can increase the cost of borrowing, companies therefore find it more expensive to borrow, they're less likely to borrow, they're less likely to expand, they're more likely to cut jobs, and workers facing the prospect of losing jobs are much less likely to ask for higher wages, and so the general pressure on the economy is disinflationary. So at the moment, the Fed's saying, yes, we're seeing disinflationary powers at work in the economy. Inflation's falling, core inflation's falling. But the Fed's preferred measure of inflation is called the core PCE inflation print. Now, I'll show you, it's here. It's here. It's coming out at 1:30 UK time. Now, this is the personal consumption expenditures print, and it measures the spending on goods and services in the US. It was around 2012 that the index became the main inflation index used by the Federal Reserve to inform its policy decision. This is the go-to index that the Fed uses. And the PCE price index has two figures. The first figure, the headline, that is from all the spending categories. And the three major categories of the report include categories like durable goods, things like motor vehicles, recreational goods, furniture, that sort of thing. Non-durable goods, they're things like food, drink, clothing, footwear, petrol. There's other non-durable goods. And then finally, services, things like healthcare, transport, recreation, insurance, financial services, etc., etc. So those three are included in the personal consumption expenditures print. And the first figure includes all the categories. Now, the second figure, the core PCE print, excludes the inputs of food and energy. So as a result, the core tends to be a better indication of where inflation is because it excludes the fluctuations of food and energy prices. And the problem with including food and energy prices in the headline is it can hide true inflation trends because it just gets mixed up with the data. So on Friday, we have the headline print and the core print, with the core being more important. Now, let's look first of all at the headline. So this is the headline, and you can see it's expected to come in at 5.4%, was what it came in January. And if we take a look what's expected for Friday, it's expected to come in at 5.1%. So it's expected to fall, right? So that would be just above the 5% region and showing another decline. And that is what the Fed wants to see. That's disinflationary, and it means they're less likely to hike interest rates. Now, we haven't got a minimum or maximum expectations for the headline, but we do have a minimum maximum expectation for the core. So the core is expected to come in at 4.7% for February. And just taking a look here, we can see that that is the 4.7% region is in line with January's print. So it's still sort of to the lower side, but the danger is it's becoming a little bit sticky. It's like putting in a bit of a base. And if you look at expectations, you can see that the minimum expectations is 4.7. So it's skewed to the upside with expectations of a high of 4.9%. Now, one of the concerns more broadly amongst analysts is that inflation is stickier or higher than investors and the market's expecting. So the market will be sensitive to a high inflationary print. And remember, really, there's only sort of two narratives you need to have in your mind. Is the Fed's thinking to themselves, do we cut interest rates because banks are starting to crumble? But if we cut interest rates because banks are crumbling, are we then fueling this inflation? So the Fed is trying to balance two major narratives: banking fears on one hand, surging inflation on the other. So although you might look at this and say, well, there's nothing to worry about, look, this is disinflationary. When you just scale out and you look over 5 years, 10 years, 25 years, you can see that inflation is still the highest level it's been for over 25 years. So headline inflation at 6% is still a big concern. The general target is 2%. That's where most central banks want inflation to be. So what that means is this as the Fed's preferred measure of inflation, with the US economy super sensitive to inflation, this is the tradable opportunity that I'm looking for on Friday. So let me just, sorry, something just fell off my desk. There we go. Right, so this is what to look at. If we have a high inflationary print, that will mean the Federal Reserve is going to be expected to need to hike interest rates more aggressively. So these short-term interest rate markets, expectations for higher interest rates will rise if we get a high inflation print on Friday. And if we see a high inflation print, that will be dollar positive, stocks negative, and gold negative. If, on the other hand, we see a low inflationary print, so this comes in, and I'll share with you the details to look at, then we'll be looking at US dollar negative, stocks S&P 500 positive, and gold and silver positive. So let's say we get a high inflationary print. What could we look to do? So if we've got a high inflationary print, we'd expect to see the headline coming in probably somewhere above like 5.3%. Definitely, if we've got 5.4%, that would be in line with the prior, so that would be high. And then the core, if the core came in 5%, So 5 and 5.3% would be an inflationary print. That would be dollar positive, S&P 500 negative, and gold negative. So kind of the ways to probably trade that, there's a few different ways. I think it's tricky to know. I think that I would trade a very short-term gold downside. So just taking a look at, oh, that was just out of interest. That this is the reason for sentiment lifting early in the European session. You can see Alibaba shares are up nearly 13%. There's been a lot of scrutiny about how China is going to respond to its tech companies, and Alibaba's been split into 6 different units, and it's been seen as a positive move for China tech companies, lifted Alibaba stocks, and has also lifted sentiment to start the day. And in lieu of not having any banking fears to majorly worry about, it's just allowed stocks to track higher today. So let's look at gold. So this is a high inflationary print. I think scalping gold would make sense. But the reason it would make sense is that gold has, had a really good run to the upside, and the reason for gold's gains have been, as we've seen, real yields drop and the dollar drop. That is just a real catalyst for gold to the upside. And the reason real yields have dropped is because interest rate expectations have just fallen through the roof because of the banking contagion fears. So that's what short-term interest rate markets are saying, oh no, the Fed's going to have to be cutting interest rates, yields are dropping, but because inflation stays high, that means real yields are falling sharply, the dollar's falling sharply. That is like a big reason for gains in gold when that happens. So with that announcement, if we see high inflation, the headline if the headline is 5, right, sorry about this folks, if the headline is 5.3%, and if the core is 5% or higher, so 5 and 5.3%, then you'd expect gold to flush lower. Now, this is a bit trickier. I would only look at a short-term scalping opportunity, looking to trade 2 pivot points, okay? So say this, for the sake of argument, say it was like today, and you had a really high inflationary print, headline at 5.3%, core at 5%, I'd expect gold to flush lower to around 1940, and I'll be looking at taking profit there. Now, I wouldn't be holding it for a swing trade because medium term, I'm still expecting gold to find buyers. Why? Because real yields have fallen, the dollar has fallen, and one inflationary print isn't going to totally change everything necessarily. Famous last words, it could do. So if it was a very high inflation, yes, of course, it could change everything. But in terms of holding the short, I wouldn't have the conviction, and medium term, it is acceptable to buy gold from 1900 with stops just sub 1800 at 1799. So short term, gold selling makes sense on a high inflationary print. That would be my go-to for Friday. Now let's cover the other eventuality. If it is a low print, so say the headline comes in 5% or 5.1%, and the core comes in 4.6% or lower, that should weaken the dollar, lift S&P 500, lift gold. So then it's much easier choice. You can go long gold or silver, both would be acceptable. I would expect upside in the S&P 500. So again, you could trade that. And if we're sat underneath this major trend line on the daily chart, as we are now, you'd expect a run. And if that breaks 40.50, you expect a run up to sort of up towards that 40.60 region. So, 40.50, you expect stops to run up to 40.60. If we get break above that trend line, that would be acceptable on a inflation miss. Definitely worth looking at. You could trade probably any of the major indices. You could trade Dow, Nasdaq, or the other option would be to go long euro US dollar. That would be fine. So because of the close correlation between the euro US dollar and the dollar index, just a straight euro US dollar upside, you know, scalp looking for pivot points is fine, and I expect it to potentially swing a little bit. You know what I mean? It's something, a trade you could look at holding. Whereas if it's high inflation, I wouldn't look at holding it. Whereas if it's low inflation, I'd be much more inclined to hold it, notwithstanding the banking fears. So there we have it. This is what's expected. Friday, if we get a high inflation print, headline 5.3%, core 5% or higher, expect gold downside. If we see the headline coming in lower than expected, say it comes in at 5% and then 4.6% for the core, I'll expect upside in the euro US dollar, S&P 500, gold and silver. So there we have it, folks. If you've just come along here today for the first time, do check out my blog. I've got lots and lots of really good resources and articles. You can just search, you know, and I go through some major macro fundamentals each week. I look at central banks each week, and there's a whole wealth of material in there for you. So don't miss out. Do go along to my blog. I'm just pointing you to my blog now. And you should get a link to that. I should say this is HYCM's blog. It's just that I do, you know, 95% plus of the material is my material. So you can follow along here as I consult for HYCM. Folks, I hope that's clear. It's a good opportunity. Don't underestimate the importance of this print. Very important. In fact, just preparing for this, I was looking at, you know, a month ago, we were looking at this as a, you know, key focus of the week for last month, and it remains a key focus of the week this week as well. So, okay, folks, thank you all very much. Do take care, and I look forward to one announcement. I am on holiday, on vacation next Monday and Wednesday, and it's Easter bank holiday the following Monday, so I won't be back until the workshop a week on Wednesday. Okay, so not next Wednesday, the Wednesday after, I will be back doing these workshops. So let me just check out my calendar so I can give you a date. So I will be back on Wednesday, the 12th of April. So pop that in your diaries. That's when I'll be back for the workshop. But I'm not around for Monday's webinar or for the webinar on the 10th of April. But I am back for the 12th of April. So I will look forward to getting stuck into another risk event then. Okay, folks. Take care. Thank you all very much. Goodbye for now.